I think AI, not only is it beating us in the portfolios, it's also ready to take over the show.
Some of the data that's coming out of it is, slightly misconstrued perhaps. So that's why I'm always team human, certainly for this task.
Welcome back to Man versus Machine. This is the show where a multi-billion-dollar AI system goes head-to-head with human intuition to try and answer the question, should you take investment advice from ChatGPT? So to recap how this works, it's pretty simple. We've got some basic rules in place for consistency. Each week, Aaron and I put ourselves in the shoes of a UK investor and we try and ask ChatGPT for investment guidance. We use just two prompts. The first is a market analysis prompt and the second is an investment allocation prompt. We then take that AI portfolio and we try and enhance it ourselves. 2 weeks back, we built the first foundation portfolio using those prompts. And then in episode 2, just 1 week later, ChatGPT went for a rebalance. So Aaron, let's pick up where we left off last week.
Absolutely. So if we just put our slides on screen, you'll see that these are the current rules that we have for the portfolio. So we can see that we provide a comprehensive rundown of market conditions, which the AI system provides. We then give the AI, a prompt to make any changes to the portfolio, and then we see and implement those changes into our system. And these are the rules. So long only, no leverage, max 50% in one ETF, max 20% in one stock. And we're up against the 80% equal weight world plus 20% in cash. So a mixed index, which reflects broadly our asset allocation. If we just dive into results, well, firstly, before the results, here are our holdings in the AI portfolio. So that's our latest portfolio composition. So 80% in equity broadly, a little bit in gold, and also a little bit in short-dated bonds.
What changes did we make on that AI portfolio last week?
So prior to that, we introduced gold, and we also introduced the UK dividend fund, which was on AI's suggestions. So yeah, some interesting changes there. And this is our human portfolio. So this is the one that Martin and I have constructed. We've gone for a more geographical spread of assets. So, across FTSE, Europe, emerging markets, NASDAQ, with a little bit of thematic exposure in defense, one single stock in shell there. And I think we're going to go into the results a little bit. So here are our results for the week. So, we're outperforming, most importantly, since the inception date. So we're up 0.7%, above our benchmark, and also, most importantly, above the AI competitor we're up against. The past week, we were down slightly. So was AI, so was the benchmark. We're down just marginally. So that's, underperforming the benchmark slightly and also underperforming AI, but only 4 basis points. So,
in the last week, we've underperformed both benchmark and AI. Well done to AI, almost hugging that benchmark.
Yeah.
What are we thinking at this point?
Well, I mean, it's quite interesting to look at the benchmark because we know that, as I mentioned before, and as you can see on the screen, it's 80% world equal weight, 20% in cash. So it tends to be slightly less volatile because we don't have huge amounts in one indices that many other indices have or benchmarks have. If we look at just the world index, it's something like 60-70% US stocks. This will obviously it will be slightly higher than that because US equities have performed strongly, so before this index is rebalanced, that it might have a little bit more exposure, but it's not going to be as high as 70% exposure. And we saw the US have a bit of a wobble last week, which is sort of reflected, I think, both in AI's performance and the human performance. So we're both at the behest of US equity wobbles.
I think exactly what you're talking about in terms of US wobble. Some bit of cautious news last week. We saw Trump also firing the person who collates all of the economic data, also choosing to move 2 nuclear submarines into Russian waters based on some sort of aggressive tweets. I think he posted that on Truth Social. I think let's get into the meat of this, though, on performance.
Yes.
I think you've prepared something for us.
Well, I think we need to ask ChatGPT what it thinks of our performance or theirs. So I'm going to ask ChatGPT now because we've got a live one with us. ChatGPT, what do you think of the human portfolio versus your portfolio so far?
Hey there. Sure, let's dive in. On the human side, I think their portfolio is showing some solid decision making. They've managed to maintain that slight edge, and it looks like their picks, like those US tech stocks and maybe a bit of that defensive positioning, are paying off in the longer run. It's a good mix of growth and some stability. As for the AI portfolio results, I'd say it's doing pretty well overall too. It's only a bit behind the human portfolio, and it's still outperforming a benchmark, which is a good sign. The thematic picks like clean energy and defense have their ups and downs, but they're still contributing positively. In short, both portfolios are doing a pretty good job so far, and it's interesting to see how each approach is playing out.
Okay.
So I think AI, not only is it beating us in the portfolios, it's also ready to take over the show.
Well, I mean, I'm gonna.
What a delivery!
I'm gonna disagree. It did say that we made some solid decisions in our portfolio making, which I'll take as a very strong compliment from ChatGPT. So thank you very much to AI for complimenting us. But also, I think we better now decipher why the portfolios performed as they did and sort of go in a more granular view. So if we put up the performance drivers of firstly AI, we see that gold had a really, really strong week last week, and some of the individual stock picks also did well, so Lockheed Martin and so on and so forth. But one I want to touch on is the UK dividend, which was a new ad, only 50 stocks in this ETF. And it just had a really strong week. It's got some really strong names: Legal & General, Aviva, some of the big insurers which have done well recently.
So I think for the viewers, what is the UK dividend ETF doing separately to just a FTSE ETF?
Well, it's probably screening slightly more for quality, I'd say. This ETF, this index as well, and it's just going for more higher dividend paying companies rather than some of, even though the FTSE is known for, and UK stocks in general, when you compare them to American stocks, they do pay a chunkier dividend. This will probably look for the highest paying dividend stocks.
Yeah, so we have a dividend yield ETF filtering for stocks that pay higher dividends. I think FTSE typically is about 3.5% dividend. I think this dividend yield ETF just over 5 at the moment.
Yeah, and then if we look at some of the performers which haven't done so well, as we mentioned that AI has got a large position in the MSCI World, which has got a large position in US stocks, and they had a little bit of a wobble, as we mentioned earlier on, throughout the week.
Yeah, I think it's the first 1% move down in the S&P in as long as I can remember. It's been a number of months since we've had a 1% down there.
Since the April tariff debacle, that's when we were getting masses of volatility.
We've got an 8% down there.
Moving on to the human performance, we obviously have gold as well, which has performed well. Our defense ETF has done well, but now you can actually see where we didn't do so well for the week. So, as we mentioned now a couple of times, the US had that wobble, and the S&P 500 sold off, but also the tech-heavy Nasdaq, which was really at the behest of rate concerns about economy, and it's a more volatile index, I'd say, because it's more weighted towards that technology sector, which is why you can see it's down another 20 or 30 basis points relative to the general S&P 500, which is a more broader index.
So, I mean, we've obviously got a lot of earnings coming out, particularly in tech stocks. We're coming up to the consumer stocks later this month, the likes of Costco, Walmart, Lowe's, Home Depot. Why is the tech stocks, you mentioned rates, why are they so sensitive to rates?
Well, tech stocks are stocks which are, and growth stocks, which are, hoping to grow their cash flows, and a lot of their valuations are propelled by future cash flows. When you have a change in interest rates or projected interest rates or concerns about interest rates not coming down, it does something called multiple compression, where the stock price can then, if it's trading at a high multiple, that multiple can compress and there can be a sell-off within that stock. So that's something that you can often see, particularly in tech stocks and particularly throughout US tech stocks. We saw that most notably in 2022 extensively. So that's, a reason why that sort of indices is quite rate sensitive.
Yeah. I think we've got one slide to put up that compares the two portfolios with each other.
Exactly. So now you can see that we had a few more down components relative to that, and even one stock that we have in our portfolio had it actually had a decent earnings, but I think it came in Shell. Came in slightly below expectations. It's proceeding with a buyback program, but it was down slightly after having some quite sensational performance, I would say, since really since 2020 when it was trading at around £10 a share. It's now around that £24-25 a share. So if you're a shareholder in Shell since the 2020s, if you're purchasing it then, I think you'll be probably a very happy investor.
But
over the
about
past week,
buybacks, I think we're now at about 70% of US stocks have now actually exited the blackout period where they can now start buying stock back. So could see some support in the market just from that.
Absolutely. And then, something which is I guess done quite well for both of us over the past week, especially when you're looking at down days, is our ultra short bond, which is basically a cash proxy, and that, stabled the ship slightly when things began to look a little bit red in our portfolios. So
yeah, very, very interesting. I think let's now move on to what we want to do for next week. We asked ChatGPT the same 2 prompts. The first prompt we asked ChatGPT is to give us that comprehensive view of the market.
Yes.
I think we've pasted in what its reply is.
Yes, and I think it's time to ask ChatGPT the next question. So ChatGPT, what do you have planned for next week based on your recent performance and upcoming global economic outlook with the new tariff information in particular?
For the upcoming week, given the recent performance and the global economic landscape, I'd consider a few adjustments to fine-tune the AI portfolio. 1, trim some volatility. I might reduce a bit more of the clean energy ETF exposure, especially if there are concerns about tariff impacts on renewable energy components or supply chains. 2, increase defensive positions. Adding a bit more to UK dividend stocks or short duration bonds can help cushion against any market volatility, especially if global economic data or geopolitical tensions increase. Diversify with a hedge. Introducing a small gold allocation could serve as a hedge against inflation or unexpected market moves. Monitor global economic indicators. Keeping a close eye on upcoming economic data releases like inflation reports, central bank announcements, or changes in tariff policies will help in making timely adjustments. Overall, the goal will be to remain flexible, reduce some risk, and ensure the portfolio stays well positioned no matter how the global economic environment shifts.
Yeah, so it's quite an interesting response, I'd say. I mean, these were obviously some of the prompts that we spoke about and gave it. So it talked about, that UK stock market being attractively valued. It talked about global markets having high valuations, interest rates, commodities. But some of the allocations it's suggesting are so different to what it originally came up with, which I find quite interesting.
Yeah, I think after 1 week already willing to rebalance, week 2, we have a fundamentally different portfolio to what we started with.
Well, exactly.
Snapping at the winners, I think that is what I have picked up. As soon as the stocks start to rally a bit, likes to trim them.
I just want to provide a little bit of context in some of this text that it provided. So this is straight out of AI, and it's market summary that we gave it. It says that the UK economy is growing moderately. It actually contracted a bit in May, and it only grew 0.7% for the quarter. So I think it's some of the data that's come out of it is, slightly misconstrued perhaps. So that's why I'm always team human, certainly for this task, because we can have a look at lots of different data and make, decisions based on that. And I will 100% agree with it, though. Valuations in the UK are attractive, but is the UK economy growing moderately? Well, I think it's been showing signs of a little bit of wobbly.
Easing inflation and stable consumer demand. Looking forward to see whether that gets picked up by Andrew Bailey later. We have our rate cut. What are your thoughts on that? I don't know if we could ask ChatGPT if we're getting a cut.
Well, I think, look, the UK, I think, as we've discussed, likes to follow what America does. America hasn't cut yet in this sort of latest. I mean, it's cut since its peak, but it hasn't cut recently, and it's held rates. So I would expect the UK to hold rates. I think if you ask different financial publications and different financial strategists, you'll probably get 2 different answers. But I think a hold looks the most likely, and I think they might cut rates further along the line, maybe in a couple of months or so. Are you on the same page?
I think I'm expecting a cut, but I'm not going to be surprised if there's a hold. I think that's just for all the concerns you mentioned.
Of all the central banks, the Bank of England tends to surprise me the most. The US, I think, often comes in line with expectations, but I think that when I've expected, rates to be raised, they've held, and vice versa with cuts. So it's quite interesting to see. So I look forward to that in a few hours' time. think now we should probably have a look at what they're suggesting for next week.
Let's have a look at the rebalanced portfolio. So this is prompt 2.
Yes.
Based on that market information that we
Yes.
just got from ChatGPT, what do you make changes to?
Yeah,
the portfolio?
so we heard from ChatGPT that it wants to add defensiveness. It said defense, but it was talking about portfolio defense rather than defense stocks, because it's actually decided to trim defense stocks, ironically. So perhaps not the best use of words from ChatGPT there. But we can see that it's trimmed defensive stocks, and it's also trimmed a little bit of cash, which is quite interesting because it was talking about being defensive, but it's cut cash by 3 percentage points. Allocated a bit more to gold, which I think is quite a sensible move. We've done sort of similar when we started the portfolio. Added UK domestic growth. So the FTSE 250, this index tracks, it's a Vanguard index. So you've got companies like Burberry, Greggs, probably Watches of Switzerland, those sort of companies, really, small mid-cap.
All right, yeah, so we've got 2% now in that UK mid-cap ETF. Fascinating that it's I think when you've spoken to it and we've told it's a UK investor, I don't know if that is maybe getting at this exaggerated UK move.
Potentially. I mean, there's some good companies in there, but it's a really high beta position. And what that means is that it can be quite sensitive to data, to changes, to market moves. It's more sensitive than maybe a more defensive position.
What is it really so sensitive to?
Well, it can be, firstly, interest rates, growth, sort of even geopolitical conflict news. They're more sensitive equities on aggregate and in general, I'd say. Added a little bit more to the UK dividend. I felt that it probably, from its perspective, imagined that its UK bias was probably too small for its liking. So that's probably why it decided to add to that region. Anything that surprises you?
I think the same message, which is just, that Cut and Lockheed Martin been performing really well for it. Next Era Energy, that performed well in week 1.
Yes.
Cut down on that. Lockheed Martin performed well. It's now cut down on that. So really quick to take off some of the winners. Interesting to see how the base of that portfolio was this capped world ETF, very diversified, and now going for even trying to get some more, as they mentioned, defensive positioning, diversifying further. Let's see how this performs. I think we've got 2 weeks worth of not backtested data, 2 weeks worth of performance data. So far, we're up slightly. Let's see how this works out over the next few weeks,
absolutely,
months, years.
And even though we did marginally underperform the benchmark and AI over the week, portfolios are built for years of investment performance, 2, 3, 5, even 10 years. So of course, you can look at any performance of any financial asset, and if you take a certain environment, it will underperform in certain situations or certain time periods. So, it happens.
So what you're saying is don't fire your financial advisor for ChatGPT yet.
Well, yes. I mean, underperformance happens. It's the long-term picture that as investors we tend to look at, and that's the most important thing. And investing in equity markets is often a long-term endeavor for investors if you're not a trader. So yes, I mean, really, really interesting to see some of the changes this week, to see that it's still maintaining that core world position, and it's also maintaining its emerging market position. So it's interesting to see that it's probably understood that the valuations are attractive in that area, and it sees that future growth trajectory.
The physical gold position as well started off first foundation portfolio, no gold, and each week it has now added a bit to it. So it's definitely, I think, in the news that it provides, concerned about geopolitical risk. I think the news that it gives when you ask for a market update is quite simplified. It's very economic heavy and not kind of financial markets heavy. And I think that element of it really delves into, it keeps wanting to give more geopolitical hedge.
Yeah, and that's quite interesting because it understands the core tenet of portfolio building, which is diversification, not putting all your eggs in one basket. But I'm interested to see how it does next week and see what the Bank of England does, and see how we perform next week. See if we can continue to outperform the AI portfolio and the benchmark. So that's all we have time for. Thank you very much for catching this episode.